We're going to look at just making sure that we record. We're also going to look at, are these down payment assistance programs the right thing for you? It may not be the right thing, and that's okay. We're actually going to go over not just the Dream for All program, which is awesome, but we're going to go for a few other programs as well, if that's not the right thing for you. So let's get started. Again, my name is Richard Chung. Thanks, guys, for joining us, and I'm going to share a few slides with you. And here's the number one thing that I just want to share with you guys. Really, when it comes down to people are asking, the first question that people usually ask me is, how's the market? What's going on with the market? Are people out there still buying homes? Are people still selling homes? Are we going to have a market crash? Is it going to be like 2008? So I want to just address that real quickly. I mean, we're looking at home sales. They dipped a little bit last year, and a lot of that has to do with, the home prices or the interest rates, shooting up a bit towards the end of last year. And we're looking at home sales annually and a monthly on, as far as the season's going. You can see here towards the end of the year, home sales definitely tend to dip down a little bit. But if you look at the month of March and April and May, historically, those are pretty high. Now, home prices, this is where I want to show you guys the most. People say, oh, well, the market is crashing. The home prices are falling now. It was just way too crazy the last couple of years. That's not going to last. Actually, since 1990, it's been a consistent 4% trend in increase. And this is the long-term trend. Now, of course, in 2022, we saw a pretty big jump. 2023, still, a decent jump. So if you bought your home here in 2020, a lot of people, they got a lot of equity. But the only reason why this 4% number is, I think, a very conservative number is because we all know what happened in 2008, 2009. We had a big drop. The chances of something like that happening are just pretty much slim to almost none. That's not what we're looking at. And the biggest reason why is simply supply and demand. We have such a small number of supply, such a high number of demand. That's always going to drive prices up. So now the question is this: with so much low supply and high demand, well, how am I going to ever buy a house? These home prices are just going to be too high. They're going to be too expensive. How am I going to ever get into a house? And Tommy, our preferred lender, is going to hop on here in a little bit, and talk to us about that. But correct me if I'm wrong. What I usually see is we see the government doing all these things, such as, they had to raise interest rates to control inflation. Well, you know what? Tell you the truth, the government's not very good at these sort of things. They're not very good at all. So what they didn't anticipate is, oh my goodness, if we start raising the interest rates like this, then, people are not going to buy homes. They're not going to be able to buy homes at all now. They've been priced out of affordability. So then they try to fix up the mistakes that they might have made by releasing all these programs, and the people that benefit are going to be us buyers. So here's what that looks like if you were to buy a home today. And I'm going to just kind of go through some slides on really what the home buying process looks like. For the most part, I think we have first-time home buyers in this chat, or in this Zoom. So I'm going to go through it pretty quickly. The home buying process. I think this is important for us to understand. Okay, really, what does it look like from beginning to end? If you've never bought a home, it could be very daunting. It could be a very big task. So the first thing is selecting a real estate agent. I cannot understate how important this is to have a real estate agent. Of course, I'm a real estate agent and I'm just selling myself, but you go ahead, do your research online. Type into Google, should I hire a real estate agent to help me buy a home? You will see article after article of how important it is to have someone represent you, not only to help you find a home, but we'll talk about it a little bit later, negotiate terms. And keep in mind that negotiating doesn't just stop with the price. The negotiating can continue all the way to the close of escrow. We get a lot of buyers, or we hear buyers say, well, what if I went directly with the listing agent? Shouldn't I get a better price? The truth is possibly that could happen. But the thing that you're missing is the negotiating doesn't just stop there with the purchase price and the terms. What if you need to negotiate repairs? What if you need to negotiate an extension because you're missing the timelines? You need to take care of a few more things and now you need more time. Who do you suppose the listing agent's interest whose best interest does the listing agent have in mind at that point? It's definitely not going to be yours. So having someone on your side, someone that knows, has the experience, the guidance, I cannot understate that enough of how important that's going to be. Okay. So first thing we do, we select a real estate agent. We've got a few on this Zoom, which I'll introduce later. And then the next 2 to 3 items are going to be really, you can kind of look at it as I can go one or the other, one before the other. It doesn't really matter, but it's getting pre-approved and then also having a needs analysis. Let's face it, most of us are on this call because we're going to need a loan. We don't have the cash to just buy a home, and it's okay. The majority of homeowners bought their first home with a loan. So the first thing you want to do, or second thing, is going to be get a pre-approval. Here's what that looks like. Generally speaking, a lender will be able to look at your debts, look at your current income, and see what kind of buying power you have. If your buying power is $700,000, you don't want to start looking for $1 million homes. So we want to look at what is your buying power, and also what would your interest rates look like? What is your monthly payment gonna look like if you were to move forward with it? And we'll talk about interest rates and monthly payments in a second. And then the next thing is a needs analysis. Well, as your agents, we want to know what you're looking for in a home. There are going to be needs, there are going to be wants. Now, I mean, of course, the biggest thing that you can't change is going to be your location. So we want to look at, well, I want to look at a home in Long Beach, or I want to look at a home in Cerritos. Well, it's going to be our responsibility as agents to let you know, what is the market like in Long Beach at the current moment? What's the market like in Cerritos? What are the buyers paying for a 4-bedroom, 3-bath house in those areas? What are buyers currently paying for a 3-bedroom, 2-bath condo in those cities? And I tell buyers all the time, start looking for properties, start viewing properties soon, because that's going to help. That's going to be your way of doing your own homework, your way of doing your own research, because there are going to be things that you thought you needed. You're going to realize, okay, I can go without it. And there are going to be things that you didn't realize were really important to you. But as you're looking at homes, you're going to realize, oh, actually, I would really love to have that. So going out, selecting new properties are going to be important. And what one of our agents can definitely do for you is we set you up with is called a search alert. So when you tell us, hey, I want to look for a home, a condominium in these cities, Torrance, Carson, and Gardena, we'll set up and I want a 3-bedroom, 2-bath, and my budget is $600,000 to $700,000. We're going to set up a search alert so that once those properties hit the market, either as an active or as a coming soon, you're going to get an email right away with an opportunity to go tour that home. So select and view properties. Next thing is writing an offer. Now, here is where the experience will definitely come in. We sell a lot of homes as well. We list the homes for the sellers. And so we review a lot of offers. And I will tell you this, we get offers written from agents, and I'm just like, what is this agent even thinking? And to tell you the truth, I even feel for those clients. I'm like, man, I feel bad for you guys. You guys have an agent writing this offer that really may not even know what they're really doing. They're not writing you a very strong offer. We want to make sure that when we write an offer, we have a proven way to get your offers as strong as possible with the highest possibility of getting accepted as possible. Because when you find that dream home, you want to make sure that you have a strong offer. Wouldn't you guys agree? You want to make sure that that offer is written strong. It's not just about finding the right home, but in most cases, you're going to be competing with people. So we want to make sure we write a strong offer, which also doesn't mean we put you at risk. We're not going to just write an offer for the sake of being strong or for the sake of being the one that's winning, but we want to also make sure that we protect all of our buyers. We want to make sure that we're not putting our buyers in a situation where we're going to say, hey, accept our offer, we'll close escrow in 6 days, when that's not the realistic timeline for our buyers. So we want to make sure that we have our buyers best interest in mind when we're writing an offer as well. And that's where this needs analysis takes place too, where we're going to be having conversations and really asking you guys the right questions on what you can do as far as terms and what you can do as far as timeline, not just what you need, but really what could work best for you guys. Okay. And then negotiate. I'm proud to say that we have a team of just amazing negotiators. And I mean, if I may even say so myself, I teach on negotiating, on how to negotiate the right offers. And in order to negotiate, it's not just about being able to talk well or being aggressive. It's not just about those, but being a good negotiator means you're just well experienced with your options. You know what's available to you. You know what you're able to negotiate, what's legal, what's not legal, what's strong, what's not so strong. And we definitely have that experience when it comes to negotiating. Okay. The next thing is once you're under contract, you actually have a period where you are able to say, hey, you know what? This isn't the right home for me. And that's the period that we want to make sure isn't the right home for you. So the first thing we do is we conduct inspections. We bring in the experts. We bring in the professionals. We want to make sure that the professionals are saying, oh, you know what? Your roof looks like it's pretty good, but you may want to work on upgrading your electric panel. Okay, great. So how much is that going to cost? Or wow, it looks like there was a leak here at some point. You may want to ask the seller about it. Then we'll go to the seller and say, hey, there was a leak here. There's evidence of water damage. What happened here? Was there a roof leak? And then we go into and we dig deeper into the physical aspects of the home. And not only just the house itself, but we also inspect the neighborhood. Is it near train tracks? Is there a school nearby? Is there going to be a lot of traffic at 8 a.m., 3 p.m.? We look at the neighborhood as well and all the disclosures that we get from the sellers. During that time, the lender's also going to conduct an appraisal. They're going to hire a third-party appraiser to make sure, hey, this appraiser's job is to let the bank know, yeah, we agree. We do believe that this home is valued and worth the amount of money that your client is offering to pay. Once we do that, and during all this, the lender is working hard behind the scenes. They're making sure that they can get an underwriter to approve the loan and that you guys are good to go, that we're not going to run into any bumps in the road. So for example, a lender may say, well, there's actually a $20,000 cash deposit. Could you explain what that means? We want to make sure that the underwriter is okay with that. So that's the steps. Those are the steps where the lender is making sure, yes, this is a loan that looks like the underwriter is going to approve of and will get you the money. Okay. We also do a title search. We make sure that this home is first of all going to be insured with title insurance, because sometimes, let's say there is a seller that you're buying this home for, hired a plumber a couple years ago, never paid the plumber. So the plumber decides after you buy the house, I'm going to put a mechanic's lien on it because this previous owner owed me $2,000. So I'm going to put a lien on the house. Well, we're going to have title insurance to make sure that you're not responsible for those things. Then we get the funds and we send your funds for closing. We do a final walkthrough, which basically means, hey, is this house still in the same condition as it was as when the offer was accepted? And then we close on the property. Now, from point A, step 1 to step 12, typically speaking, we're looking at about on average 30 days. That's what's customary. It can definitely be less than that. We've closed escrow in as little as 15, 16 days, a couple weeks. So it can definitely do that. We can even definitely go longer. But one thing to note is every property in California is sold in its as-is condition, and all the terms have to be agreed upon by both the buyer and the seller. There's no law that says it has to be 30 days. There's no law that says you have to deliver a house with a perfect roof or perfect plumbing, or that the seller has to replace the carpet. There is no law on that. All right. So with that said, let me go to the chat to see if there are any questions. No questions yet. All right, that's okay. So far, that's really what the home buying process is like. And I think this is important to know so that when we're in that process, we know what to expect. And by the way, don't worry, when we have a consultation with you, this is something that we're going to make sure that we go through with you guys. By the way, just real quick, gotta say, excuse the way that I'm dressed. It's Dodgers opening day. So, hey, opening day. So go Dodgers. Hope we win tonight. All right. Uh, Now here's the thing, guys. I mean, when it comes to buying a home, it's the money is the most important part. We want to make sure that you have the correct buying power. Yeah, go Dodgers. Yeah, we have the correct buying power, and that, I mean, okay, monthly payments. Make sure it makes sense, because what's so great about this is when you own a home, you are paying your own mortgage and building into your own equity, not a landlord's equity, not a landlord's mortgage. You're not helping a landlord build wealth, you're helping yourself build wealth. And the biggest challenge, it definitely was for me when I bought a home, and it was for a lot of people, the biggest challenge is going to be that down payment. So I want to introduce Tommy Evans from Arbor Financial. You know, I've worked with a lot of lenders in the over the 12 years that I've been in real estate, and Tommy is really, I mean, top notch, top shelf. He's got a ton of experience, and he's going to share with us a couple programs that are going to help you with the down payment, and then we'll do a comparison to see which one is right for you. All right, are you ready, Tommy?
Yeah, thanks for the introduction, Richard. So, just to get started, a little bit about myself. I'm an independent mortgage broker, and so what differentiates, me from pretty much, most of other people you're going to talk to is that we get to shop your mortgage out to 100 different investors to help you find the absolute lowest interest rate and best pricing and the best programs for you. And so, you know, one of the most talked about programs right now is the new Cal HFA Dream for All home loan. It just released on Monday. We have access to it, but one of the things that nobody else out there is talking about is the fees associated with this. Almost everybody out there is charging 2% origination fee. We're only charging 1.25%. So on average, by working with me, I can save you anywhere from $4,000 to $6,000 in closing costs, and nobody else is talking about that, I promise you. So it's not just, can you get the program, and is this program good for you, but who you're actually getting it through. And so let's just go ahead and dive into this program. I'm going to go ahead and share my screen and talk a little bit about what it takes to get this loan. And so first and foremost, it requires a 680 minimum credit score. So this is a conventional loan. So no FHA, no VA, no USDA, only conventional financing. Now the debt to income ratios are 45% if your credit score is between 680 and a 699. If you're 700 and above, we can go all the way up to 50%. So what does that mean? It means if you're making $10,000 a month, the max between your home payment and your student loans, credit cards, auto loans, you can't go above 50%. In this case, if you made $10,000, you can't exceed $5,000 per month in payment. And so that's important, for all loans to look at your budget to understand, hey, what's my payment going to be, and can I qualify for this? But also, like, am I comfortable making that monthly payment? And so you really want to make sure that we take a look at all the different options for you. And so just to kind of get going on this.
And Tommy,
Yeah,
Tommy, if I could just interrupt. So debt to income ratio, just want to make sure that everybody is clear on this. So you gave a great example. If you're bringing in $10,000 a month, you want to make sure that your monthly debt isn't exceeding 5,000. Now that, credit card payments, student loan debt, I mean, that's going to be car payments. Those are going to be big. But I also want to point out on credit card debt, it's going to be your minimum monthly payment required to keep you from going to collections, not what you're actually paying. So if you're racking up $4,000 in credit card debt per month, but you're paying it all off, $4,000 every month, that's not your minimum payment. So we just want to make sure that we're clear on that. And also too, your monthly mortgage payment, that's going to be part of that as well. So whatever, if your monthly debt comes out to, let's say, $1,500, you got about $3,500 to play with for your home payment, correct?
Exactly. And
Yeah.
one of the other things you got to also keep in mind is, a lot of these programs are designed for first-time home buyers, especially the Cal HFA, which means that you could have owned previously, but more than 3 years ago. And so with that, being that most of these programs are kind of designed for that first-time home buyer, we see a lot of student debt. And so with conventional loans, it's important to know that even if your loan is in deferment, they're still going to hit you for a 1% payment on that with the conventional loan. So this particular loan uses Fannie Mae guidelines, which is going to charge us, hit us with a 1% payment. So if you owe, $40,000 in student loans, you're looking at, $40 a month payment that they're going to tack on there. So what I did on this, just to kind of make it easy, is I kept all of the purchase prices the exact same at $700,000. And then I used the absolute minimum down payment that you can do for each one of these products. And so the very first thing that you're going to see is the monthly payment on this program, which I highlighted here in yellow, is $44,264. And so this is looking at, and the way this works is you're going to get a first mortgage, which is at 80% loan to value. And then you're going to have a second mortgage that is 20% of the purchase price, that is at a 0% interest rate with zero payment. And that's why that payment on this is substantially lower than all of the other programs that we can offer. And so this is a phenomenal product. One of the biggest questions that I'm getting right now is this a smart investment for me? And so you got to look at it this way. And this is kind of the way that I look at it is, if you're paying 0% interest rate, what would you have been paying on that money had it been borrowed at an interest rate of, let's say, 6.375%, which are the published rates for this program right now? And so that would be $743 per month in interest that you'd be paying, or $8,900 a year. So you're saving
Wow.
almost $9,000 in just mortgage interest with this loan product. Now, the caveat of paying zero interest and zero monthly payments on it is the way that the Cal HFA wants to get their money back. One, they want the original loan balance back when you pay off this loan. So there's a couple of things here when the payment is going to be due. One is if you pay off the first mortgage. So 30 years from now all of a sudden you got to pay back that original balance plus 20% of the appreciation gain. And what does that mean, appreciation gain? So if you bought the home for $700,000 and you sold it for $800,000, there's $100,000 in appreciation. In this example, you would pay $20,000 of appreciation gain on top of the original loan amount that you took. So it's the loan amount plus 20% of the appreciation. Okay. So a perfect example on this is, one other thing on that before I go into the example, is that it's also capped at 2.5% of the original loan amount. So if we look at this example where we're taking $140,000 second mortgage, so that's 20% of 700,000, 140. 2.5% of that is 350,000. So the max that you would have to pay back on this is $350,000. Now that 350,000, you got to look at it this way. What's 20% in order to get to 350,000? That is $1.75 million in appreciation that you would have to gain in order to pay $350,000 of 20% appreciation. That would be a very good problem to have. Most cases, you're not going to see that kind of appreciation where you're going to get anywhere near 2.5 of that amount. And so this program makes an absolute ton of sense. So let's just look at this in more realistic time frame. let's just say you did 10 years, okay, that you sold this home 10 years from now, and it went up $200,000 since you bought it. So $200,000, 20% appreciation on that is going to be $40,000. Now, we just got done saying that it's $9,000 in interest that you're saving. So 9,000 per year times 10 years, that's $90,000 that you'd be saving in interest to basically give up 40,000. That's $50,000 net benefit that you're going to have with this program. And then on top of that, your monthly payment is going to be much less. You're going to be avoiding mortgage insurance premiums because you're putting 20% down in a way. Basically, they're putting it down for you, but you're avoiding that PMI, which is several $100s depending upon where your credit scores are. So this product is absolutely phenomenal for those that can qualify. So a couple things there are income limits. So for Orange County, they're very gracious. They'll go all the way up to 235,000. LA County, it's 180, 173,000 in Riverside and San Bernardino County. So just a couple of, things you got to look at. So 1, credit score, 2, debt to income ratios, and then 3, income limits. Okay. So those are the main factors that are going to really decide on, whether or not we can qualify you for this program. So if you look at this next little highlighted yellow in here, the cash to close figure, you're looking at about $19,400. Now that's about what the closing costs are going to be for a traditional purchase with the origination fee that I mentioned. So you got title, escrow, appraisal, all these third-party fees that are going to come into play. And if you guys want, I can show you a breakdown of that. But it's just something to make sure you're aware of. Just because you're getting 100% financing doesn't mean that you're going to have no money at all to bring into this transaction. You're going to need to have money for at least to put in your earnest money deposit. And so in order to secure that property, the sellers want you to put money into escrow to show that you're a serious buyer. And if you don't have, $10,000, $15,000 to be able to put in, it's going to be really hard to get your offer accepted. So keep that in mind. You're going to need money for deposit, which that will go towards those closing costs. And it'll show up as a credit on your final loan statement that goes against the cash to close figure. I'm going to go ahead and go to the next product. We can come back to any questions on this later. But
okay, and Tommy, sorry, did you want to address? So we do have a question. Taking your example of buy for 700K, sell for 800, you owe 140, which is the 20%, right? That you initially got for the down payment plus 20,000 in depreciation. Is that correct? You sell the home at a profit, but don't actually profit. Am I hearing that right?
Correct. So it's the original loan amount plus the shared appreciation amount. So you nailed it. So 142nd plus the $20,000 in depreciation would be a total payoff of 160,000.
So now the issue is then we're not really making any money or building any equity. So, I mean, to your example, and to answer this question, I mean, this will work out much better. I mean, $700,000 to $800,000 in appreciation, it might be just a few years. The way that the market is in Southern California, I wouldn't recommend selling it that quickly anyways. I mean, if you really want to build equity, let's just say 8 years, 9 years is how long you how long you own the home for. I would by far see a much higher appreciation than just $100,000 if you're going to hold the home for that long. In fact, if you guys would allow me to do so, if we were to just even look at it at a 5% appreciation per year, because I think this is an important part. 1, 2, 3, 4, 5, 6, 7. And then, so I'm going to look at a $700,000 in 8 years, what that home will be worth. Sorry, if you guys let me just do my math. Well, go ahead, Tommy. Let me just do my math real quick.
While Richard's doing that, one last thing that I do want to mention on this is there is a one-time subordination allowed on this product. So you can do one refinance. Couple things there. One, you have to make at least 12 payments. So we have to wait a year before you're going to be able to do the refinance. And the second is it has to go back to Cal HFA for their first mortgage. We can't just refinance you to any other loan product out there. It has to stay with Cal HFA. And you can actually go on to Cal HFA's website. You can see their posted rates on a daily basis. And since I am talking about rates, a really important thing to understand about rates is they're going to be coming down pretty much all year. Once we get past this next 45 days, which are going to be a little bit turbulent with inflation numbers aren't looking so hot for the next 45 days. But once we get to May, we're really going to see a huge impact on interest rates. And what's that going to do is that's going to cause more buyers to come back to the market, because as those rates come down, it's going to be more affordable, more competition with a very limited amount of homes that are for sale right now is going to cause those prices to go up. So right now is the best time that you're going to have to be able to get an offer accepted and really get into a home that can really start gaining appreciation pretty fast this year. And then on top of that, we're really going to see that you're going to have a great opportunity to refinance. And so if you can get in now, you get the home appreciating, we refinance you later. It's a great way to go. So did you get that
Tommy,
number, Richard?
Yeah, and the question too, there's a cap of 2.5%, correct, that you're paying back of the original loan amount. Is that correct?
Correct.
Okay, so if I were to go a $700,000 home and sell it in 10 years with the 5% appreciation every year, compounded, I'm looking at 1.14 million in 10 years. That's really a profit of a gain of $440,000. So then now if I'm, at $440,000 gain, I'm paying back my 140 that I originally borrowed.
Mm-hmm.
And then there should be a cap of 2.5% from that original amount. If I'm hearing
Which you're
that
not
correctly.
even going to hit because you're paying 20% of that 440.
Okay, so let's go 20%. I'm left with $228,000. Yeah, so I'm paying back $228,000. So out of 900, out of that amount, if I'm paying back that amount, and let's say $700,000 is what, let's say I didn't even touch that loan. I mean, of course, I'm making payments into it in 10 years, but let's say I didn't even touch that and I have to pay back that full balance. I'm left with $212,000 walking away with that much money. $212,000. And that's if I didn't even touch that $700,000 balance of the original of purchase price. Let's say I just, which would be crazy. I mean, you're obviously going to break into that by making your payments for 10 years.
That's right. And you're banking that money that you're saving, the difference of that, $743 in interest that you'd be paying otherwise. You could be investing that. This is the real trick, right? If you take that money and invest it with compounding interest, and all of a sudden you're getting 7% compounding interest return on that money that you're saving by not having to make that larger payment. Now you're winning big time, right? So you look at that the opposite direction of, what can my money do for me with compounding interest? It's an absolute no-brainer that this product is going to be really good for those, especially that can recognize what they can do with those savings and putting that money to work in other areas and kind of looking at this a different way. Does that make sense?
Yeah. Yeah. And John, you hit the nail on the head. I mean, you basically said the real game is to hold on to the house. I mean, I don't know about as long as you can, but hold on to it till you really feel like, hey, it's a good time for me to sell. I have enough equity and we can go. So, and Rosemary had a question. Rosemary, go ahead and you can even unmute yourself and jump in there if you'd like.
Hi, sorry, I didn't want to interrupt earlier. So I have just a really simple question. Maybe you mentioned it in the beginning, I must have missed it, but can you tell me what the difference is in your table between the purchase price and loan amount?
Yes. So the purchase price is the amount that you're going to buy the home for. The loan amount is how much money you're going to be borrowing. Okay. And so how much we're lending you. Now,
Okay.
technically, you are getting a loan amount of 700,000. I just for the pay, you're only paying on that 560,000, which is at
Oh,
8% loan to value. So
okay.
that's $140,000 you are borrowing. So it is a second mortgage. And so
Oh, okay.
technically, yes, you are looking at another $140,000 in loan. But for this illustration, the way that this program works, I have to kind of put it in there differently. So let me show you where that
Okay,
is
okay.
real quick. And
No,
so
so I understand now what you were what you were all talking about. It just makes sense. So
yeah,
so
so
there's
here it is
the
right here, the
20%.
140,000.
Okay. And that's at 0% interest, is that right?
Correct.
Okay.
Zero payment and 0% interest.
And I want to emphasize how great that is. I mean,
Okay.
there have been down payment assistance programs for a very long time, but 0% interest, that's the key factor. You have that loan in there, but you're not making payments on it.
Okay.
In fact, you can
Okay.
even refi once and refi, get a lower interest rate and still keep that sitting there. You don't even have to touch it.
And we owe it. So we sort of owe it, but not like in a debt sense. And we pay it back once we resell the house. Is that correct?
Exactly.
Okay, great. Thank you.
Yep.
I'll let you
Yep.
carry on now.
No,
Thank you
great
very much.
question.
It makes so much sense.
Yeah.
Great
Thanks.
question.
Yeah, really. And so bringing this to the next column over, I have a next program is a $25,000 closing cost credit. We've got a $9 billion grant that we have allocated to help what are considered quote unquote underserved communities. Okay. And the way that we've targeted these communities is we're looking for areas that the home has to qualify itself on top of the actual borrower. And so we're looking for homes that fall in a demographic area, and we literally look it up on the census data that the government polls for us. And it's going to say what the percentage of minority living in that area is. And so as long as we're over 50% minorities, we can offer this next product. And so what it does is you can put as little as 3% down and pay zero closing costs. So we can cover every single closing cost, including if you're going to set up an impound account for taxes and insurance, which I 100% will tell you definitely want to do, because we're going to pay for those for you. We'll pay all closing costs, your interest for the first 30 days or however many days it takes for you to, day you purchase a home towards the end of the month. So it's called prepaid interest. Your prepaid taxes, your insurance for an entire year's worth of insurance, your homeowner's insurance, we're going to pay. So there's all of these fees, title, escrow, appraisal, everything is going to be covered for you with this program. And then there's always money left over that we're going to then use to buy down your interest rate. And so when you look at this next product, the beauty of this is that we have the absolute lowest rates possible with this product. And so we're locking in, 5.5, 5.625%, 5.75, depending on what your credit scores are and whether it's a condo or a single family home. And so this will get you the absolute least amount of closing costs with the lowest interest.
All right. I think Tommy froze for a little bit here. So I'll just take over. Can you, I'm not frozen, am I?
This program is.
Okay, there we go. Tommy's back.
Oh, did you lose me?
Yeah, Tommy, you're a little unstable. You're a little frozen. So I guess, Tommy, are you there? Or else I'll just kind of jump in here real quick.
I hear you. Can you hear me?
Okay, go ahead. We don't see your video, but go ahead.
Strange. Okay. Sorry about that, guys. So I'm not sure where you lost me, but I was just saying that this will have the least amount of closing costs possible, and really there's going to be zero closing costs. And you're looking at the lowest interest rate that you can get out there with this product. So that's the combination of these two makes it a very good product. There are income limits depending upon which county. So this product is only available in Southern California. So from Ventura down to San Diego, including Riverside and San Bernardino County. And then did you hear me where I was talking about how the house has to qualify? Did that come through?
Yeah, the house has to qualify 50% minority in that area.
Perfect. All
And
right.
I will say this, look, I'm a native Southern California. That's almost all of Southern California.
With very rare exceptions, right? So
Rare exceptions, you're right.
if you're looking at Newport Beach or Huntington Beach or some of the areas that are more highly populated by whites, then that's more often you're going to find that they're over 50% than under 50%.
But I mean, technically, Tommy, we even qualified, earlier Covina, for that. So yeah, it's not like we're looking at, whatever you would look as an underserved community that like in the projects or anything like that. We're looking at really a lot of suburbs. So Tommy, just to clarify, the difference between these two programs, aside from the property also qualifying and of course the income limits, you're looking at, if I can put down 3%, then I go for the 25K closing cost credit and 3% down, my closing costs are all taken care of. I get a lower interest rate. But what about the Cal Halfa Dream for All? I still have this high closing cost of what looks like it's almost 3% anyways. But now I'm paying more in interest and I'm having to give up equity. I mean, can you explain? I mean, just for me, what is the pros and cons? Why wouldn't I do the other one and not give up equity?
Yeah. And so, I mean, ultimately, I mean, if you've got 20% down payment and, you can qualify for that closing cost product, that's going to be taking the $25,000 is going to be a better way to go, in my opinion, because, you're able to already avoid that mortgage insurance. You don't have to worry about giving up an equity share down the road. And so, it just really depends upon your individual situation. But I would say, for someone that doesn't have, more than 5% down, that Dream for All product is going to be the best one for you. If you're sitting there with 20% down payment, put the 20% down and then pay zero closing costs. That's going to be a better deal for someone in that situation.
So the 25K closing cost credit, what's the minimum down payment on that?
3.
Okay, so that was my question. I mean, 3% down payment here or 3% closing costs there. That's where I was a little confused on.
Yeah, exactly. I mean, you're looking at very similar figures, but one product, the $25,000 closing costs, like you said, has zero closing costs. And the other one is, like you said, close to almost 3% when you look at it, on this loan size. It equates to almost 3% of the purchase price.
Got it. Okay.
So, which brings me to the next product over, which is a 1% down payment. Now, technically, you're going to see that the first mortgage is at 3% or 97%. So if you look at the two middle ones, the $25,000 closing costs and the 1% program, they're both at 97% loan to value on that first mortgage. The only difference is that the third column there, we can give you a 2% grant. So you're going to get, in this case, $14,000 in a forgivable second mortgage. And so the way that works is if you make timely payments for the next 3 years, that $14,000 will be forgiven. And so the way that they're going to go about this is they will forgive 25% of that the first year, another 25% of that money the second year, and then the remaining 50% will be forgiven that third year. And so if you were to, refinance after 2 years, you would only have to pay back 50% of that money, or in this case, it'd be $7,000 that would be remaining. Now this loan, where I really like it, is you could buy a 1 or 2 unit property. And so you could technically buy a 2 unit building with only 3% down, and it has no mortgage insurance. And so that's the beauty of this product. 660 minimum credit score. So if let's say you didn't have that 680 to qualify for that Dream for All product, you could then take advantage of this. Looking at duplexes, you can, or 2 unit properties, you pretty much have this or FHA. FHA, you can put, as little as 3.5% down. And then, nice thing with FHA is it actually has really low interest rates. And it also, you could technically take a slightly higher, and we could give you a credit to help you with closing costs. And so usually what I do is I end up kind of looking at those side by side. If you're, looking at a duplex, we could kind of play around with that to see which program is going to be better for you. But I did want to kind of bring it to your attention that this is going to be available. And again, with this one, there are income limits, and it's only allowed in LA and Orange County here in Southern California. There's several other counties in Northern California and in Washington that it's available in. But for Southern California, just LA and Orange County only. And then the last product is 100% financing that we can get with an FHA first mortgage. The nice thing about this product is you basically get 600 credit score is the minimum. And so if you didn't qualify for any of those other ones because you didn't have a 660 or a 680 credit score to be able to take advantage of some of those other products, here's another solution that has the lowest interest rate around, or I'm sorry, lowest credit score requirements around. No, there are no other down payment assistance products that will go down to a 600 credit score. And then it offers a second mortgage. And so that's why you're going to see that payment on it is much higher. So it has a second mortgage that does have a payment that is 2% over the initial rate that you get on the first mortgage. So for example, the rate on the first mortgage is 6.5%. The second mortgage is 2 over that, which is 8.5%. And it's a 10-year fixed loan. So you're going to have to pay that off over 10 years as opposed to 30 years. So that causes that payment to go up pretty high, which is why I have it last, because literally it's my least favorite product that I wanted to show to you. But it is an opportunity. It's an opportunity for you to have home ownership. It's an opportunity for you to start gaining appreciation and start dipping into that $440,000 that Richard mentioned that you could achieve over the next 8 years by becoming a homeowner. And so also, you don't have to be a first-time home buyer for that product. You just can't own another property. And that's the same with the $25,000 closing costs as well. That product does not require you to be a first-time home buyer. Really, it's just that Dream for All is the only one of these that is specifically for first-time home buyers. And so I think that pretty much, if you look at the cash to close for all of these, they are very low, 19,000, 21,000, 34,000, 33,000. It kind of helps you to understand that, yeah, you might not have 20% down payment, but you still can get a loan and you still can start, building family wealth and working towards the future of being able to pass something on to your children down the road. And so, I've been blessed with, my house is, doubled in value since I bought it back in 2015. And, I don't know too many other things that you can do to make such a huge impact on generational wealth like you can with home ownership.
Yeah, that's exactly right, Tommy. And the reason why we wanted to do this as well is to inform buyers. You're going to hear a lot of things online, on YouTube, on the internet. I mean, even with this webinar here, what I would love for you guys to do. I mean, Tommy, take a screenshot of Tommy's contact information on the top left of the screen, and also get connected with one of us so that we can help guide you through it. I mean, just that one. And look, if you're not sure which product is right for you, that's the perfect opportunity to have a conversation with Tommy and with one of us so that we can get you into a home. I'll share a quick story. We sold a home last year in Los Angeles, and we sold that home where the parents, they did pass away. And so, it was in a trust. It went to the kids who are a little bit older. I mean, the kids are in their 50s. So the kids of that home, the home was originally purchased in 1970. Of course, yeah, I know I'm talking 40, 50 years ago. So it was a long time ago, but it was originally purchased for $55,000. We sold that home for almost 1.9 million. So it was, of course, it was paid off. The two kids of the parents were left with almost $1 million each. I mean, that's generational wealth. And they took that money, they invested it, they're putting it in, that's going to probably go to their kids. So I also look at it as, wow. I mean, yeah, it was 50 years, but still $55,000 to almost 2 million. That's a pretty high amount of appreciation and wealth that you're leaving generationally.
Yeah, Richard, one other thing I kind of want to bring up is just that, there's a lot of information flying around about these products, and unfortunately there's a lot of loan officers that don't understand how these products work. Give you a perfect example. One of Richard's clients actually was buying a new construction property, and this program just came out, and he asked them whether or not they qualify for it. And he was told no, that they don't. And I talked to him. I was like, well, actually, you do qualify for this, because they go off of the qualifying income, not the household income. And, just because somebody might tell you, no, you don't qualify for it, doesn't mean that they're correct. I'd like to say that, everybody out there knows what they're doing and do a really good job, but that isn't always the case. Somebody might be doing loans for 20 years, but they might not have ever done one of these Cal HFL loans. I've been doing them for over a decade. And so I'm very familiar with, the products, the guidelines, and really how to get these done in an efficient manner. And that makes a difference, especially when you're writing offers, to have somebody that knows how to close these on time and knows how to say, hey, look, you're not going to be able to do this in 20 days. Like, you're going to need 35 to 40 days to close one of these typically. And so, you got to make sure that when we're structuring your offers, that they're being structured right as well. That's important.
Absolutely. So, I mean, unless there are any questions, we'll close with this. Look, why, whenever someone's giving me something for free, I think to myself, is this too good to be true? What's the catch here? Well, here's why the government is doing this. For every home purchase that a buyer makes, it stimulates the economy by pumping about $50,000 into the economy. Because when you buy the home, you're going to have to spend money at Home Depot. You start getting a new landscaper. You start, maybe getting a pool guy. You start doing renovations. So $50,000 is spent into the economy within the first 6 months. By the way, 6 months, and that's why the government knows home ownership and buying a home is the best way to stimulate the economy. So the government wants to do this. It's a win-win. Secondly, I want to just introduce Tommy. Can we stop the screen share real quick?
Yep. Sorry about that.
And just for those that are here, thank you guys for coming. I want to just introduce, we have some of our agents here that are on, and if they want to just share something real quick, but they are here to help you guys, guide you guys. They're all super experienced. So we have Chris Kawasaki, we have Emma Rake, Carlos Hudgens. Contact one of them. If you're invited by one of them, let's get together. Let's have a conversation. We also have David Crespo, who's our preferred farmers insurance agent. One of the best. I mean, he's already saved my family a lot of money. He knows that. He saved one of my closest friends a lot of money just recently as well by switching over to him. Any last words from anybody from the Veritas Group? No, all right. And then we also have Jasmine, who's the head of our admin team here. So she does all the admin for us as well, and to make sure that your escrow is closed and everything's good. And for all of you guys that are here, we'll make sure that you guys get a recording of this webinar as well. All right. All right, guys. Thanks for joining us. We stopped right on time. Have a great weekend. Let's go Dodgers opening day. Here we go.
Well, Doyers.
Dodgers, go Dodgers.